The stock market can hit another all-time high while you quietly run out of money. And the worst part is nobody is telling you it is happening on purpose until it is already too late. You are watching the same movie rerun. Different actors, same plot. A system designed to sell safety to ordinary people while moving real risk into the shadows where it can never be priced correctly. This is not financial advice, this is financial education. And if you feel that your life is getting more expensive, your wages are not keeping up, and yet the headlines talk like everything is fine, that mismatch is the clue. In 2026, the clue is even louder because AI is destroying jobs while also making the rich look smarter on paper. Let us connect the dots with what happened before the last major crash and what is being built now, right under your nose. In 2026, you can feel the squeeze in small daily ways. Your rent rises again even though your salary did not. Your groceries went up so much that you stopped remembering the old prices. Your retirement plan looks healthy on a dashboard, but you also hear that Social Security is underfunded and many pensions are already living on borrowed time. Meanwhile, the Fed keeps adjusting interest rates based on inflation readings that sound calmer than your bank account. It is like they are measuring the weather in one part of the country while you are drowning in another. And here is the question you should be asking, the one people avoid because it is uncomfortable. What kind of financial machine can keep selling you safe assets when the real world is breaking your spending power? What kind of institution can keep the stock index rising while households are getting crushed by housing costs, insurance costs, and layoffs from AI automation? The answer is not magic. It is packaging. It is leverage. It is regulation drawn with a pen that only the powerful can read. And it is a willingness to shift risk away from the people who designed the risk in the first place. Now I am going to take you back to a real mechanism that helped create the 2028-style denial we lived through in the last cycle, even though the timeline will sound familiar. The story people remember is housing bubble. But the truth is uglier. Housing was not the bubble. Housing was the raw material. In the mid-2000 era, there was a man named Michael Burry. He worked like an accountant with anger. While other people treated rising house prices as a reason to get drunk, he treated rising house prices as evidence of fraud. In the spring of that era, he walked into a Wall Street bank with a proposal so aggressive it should have been laughed out of the building. He wanted to buy a bet that the bank would fail and that the U.S. housing market would collapse. The bank manager did not just reject him, he looked at him like he was insane. He basically said, "How can you bet against a place where everyone is making money? How can you short a machine that is feeding the wealthiest investors with cash every month?" Then Burry did not argue. He kept going. He expanded the bet across multiple firms, demanding massive size. People inside those buildings reportedly treated the deal like it was free money. After all, when prices only go up, risk feels like a myth. Years later, the world watched the financial system seize up. The bet paid. Not because Burry was lucky, but because he understood something most people never want to understand. When you build a profit engine on the assumption that everyone will keep paying forever, you are not investing. You are renting reality. And reality always has an expiration date. Now you might be thinking, that was then. We learned, we regulated, we improved the system. You have been told that story so many times that your brain now accepts it like background noise. But in 2026, you can see the mismatch between the story and the outcomes. The crash mechanics did not disappear. They changed costumes. They moved into new asset classes with new buzzwords. They became safer looking on reports while becoming more dangerous underneath. Because the core strategy stayed the same. Find a large pool of cash flows, break them into contracts, bundle them into something that looks like a stable asset, and then sell the final product to institutions that do not want to think too hard about the underlying defaults. During the last crisis, the raw pool was mortgages. Specifically, mortgages made to borrowers who were never going to qualify under normal standards, underwritten to perform in the short term, then cracked open when payments failed and house values stopped rising. In the new cycle, the raw pool is not just mortgages, it is data center leases, artificial intelligence infrastructure spending, high-priced computing capacity, and the financial derivatives that make those long-term promises feel investable. And here is where it gets truly nasty. You are not just hearing about this in financial podcasts, you are watching it in the real economy. When big AI companies expand, they need data centers. Data centers need power, they need cooling, they need chip infrastructure, they need racks, they need GPU supply chains. You and I see innovation and progress. They see a cost center that eats money before it produces profit. So what do? They do not want to put the big spending on their balance sheet, because if they do, investors will punish them with valuation pressure and debt concerns. The easiest way to avoid the headline "we are heavily indebted" is to borrow invisibly. That brings us to the mechanism that people keep repeating with new names: special purpose vehicles, or SPVs. Think of an SPV like a suitcase for risk. It is a legal structure built to hold a stream of payments and then issue financial claims backed by those payments. It can take leases and turn them into bonds. It can take future revenue promises and sell them today. In other words, it can turn expensive real-world commitments into a financial asset that looks like safety, even when the underlying economics are fragile. Let us make this concrete with a simple image. Imagine a company like Meta wants to build an AI data center. It could pay for it directly, but that would create big capital expenditure costs and show up as liabilities. Instead, it finds a financial engineering route. An intermediary, often part of what used to be called the shadow banking system, arranges financing through lease structures. The intermediary builds or funds the data center, then leases it long-term back to the AI company. The AI company signs the contract. It commits to paying rent-like payments for years. Now the intermediary asks investors for money. It sells bonds to institutions. It says the bonds are backed by lease payments from major corporations. And because those corporations have strong credit profiles, and because the intermediary can structure the deal in layers, the bond can receive ratings that make ordinary buyers comfortable. You are told, in effect, that the risk is minimal, because the lease payment is guaranteed by strong companies. The bond looks like a safe place to park money. But safety here is mostly a storytelling problem. The lease payment may be enforceable. The bond may have collateral. The SPV may be designed to prioritize payments. That is all true. Yet the real economic risk is not only about whether the contract can be collected. The real risk is about whether the economic assumption behind the lease remains rational when the technology shifts faster than humans want to admit, because AI infrastructure becomes obsolete at ridiculous speed. Chips and GPUs are not like buildings. A building might last decades, but the computing hardware inside a data center can become outdated in just a few years, sometimes less, as new architectures and performance per dollar improve. Picture the following micro-story. A 28-year-old software contractor named David loses his contract after a company decides an AI system can do the same work with fewer people. He starts looking for stability and hears that AI is a booming economy, so maybe his future will be secure. A few months later, his pension portfolio quietly adds more high-grade assets through a retirement manager. He does not see the details, he sees performance. Then a year passes. The data center costs did not decline. The lease obligations did not vanish, but the value of the leased equipment starts dropping faster than the payment schedule was priced for. And eventually, someone somewhere decides they would rather pay a penalty to renegotiate the lease than keep paying for capacity that is no longer the best use of money. That is when the bond market has to discover what the structure assumed and what it could not protect you against. Defaults do not always look like a borrower missing a mortgage payment. Sometimes defaults look like a renegotiation, a restructuring, or a liquidity freeze when refinancing becomes impossible. Now step back and connect it to 2026 reality. In 2026, rates have not returned to the zero world people got used to. The Fed can cut sometimes. It can pause. It can sound relieved when inflation falls from its peaks. But inflation damage does not reverse automatically. Your purchasing power still has scars. Many households are still carrying high-interest debt. And if you look at housing, it is worse. Housing prices did not just rise and fall, they detached from wages in places like the United States, the United Kingdom, Canada, and Australia. A generation is now renting longer, building less equity, and facing a future where affordability is not a temporary problem. When affordability collapses, it hits employment, it hits consumption, it hits insurance models, it hits local budgets, it hits everything that makes default rates possible. That is why the market keeps doing this weird dance. Stocks can rise, corporate profits can look strong, the index can hit highs. Meanwhile, households can still be drowning. The disconnect is not random, it is structural. The stock market is forward-looking and concentrated. Many investors own the same tech giants that benefit from AI adoption. Meanwhile, the average worker, especially one without wealth buffers, feels the real economy pressure immediately. But the risk engine still needs a place to hide. It cannot hide in cash flows that are already obviously failing, so it hides inside future promises, bundled, rated, and sold. And here is the first cliffhanger you need to understand before we go further. In the last crisis, those bundles were mortgages and mortgage derivatives. This time, the bundles can be data center leases and other long-term infrastructure like cash flows linked to AI and the financing around them. The names change, the method does not. Now let us address the comforting question you have probably heard from someone with a pension plan and a cheerful outlook. They will say, if markets dip, they always recover. Stocks always bounce. The Fed will step in. Technology always wins. You cannot lose forever. That story is designed to keep you passive. It is not a strategy, it is a lullaby. Because when people say recover, they are often talking about a chart. A chart can recover while your life never does. You can experience permanent loss in your ability to buy a home. You can experience job displacement that never gets reversed. You can experience retirement contributions that get cut because your cash flow cannot sustain them. Also, the Fed stepping in is not the same thing as saving everyone equally. In the last cycle, the Fed and emergency lending helped stabilize the system. But ordinary people did not get their losses compensated the way financial institutions got their balance sheets repaired. To understand the deeper mechanics, look at what happened in 2008. The initial shock was not just house prices falling. The shock was when the system learned that a large portion of safe assets were based on borrower behavior that was never sustainable, and house values that were never guaranteed. Those safe assets were safe in the documents. They were unsafe in the real world. So what is the proof that this pattern can repeat? The proof is structure. It is always the same. First, you find or create a pool of debt or payment obligations that can be packaged. Second, you blend it in ways that obscure the true risk distribution. Third, you recruit rating agencies or similar verification mechanisms to stamp legitimacy on the package. Fourth, you sell the product to institutional buyers who need yield, stability, and liquidity. Fifth, you keep the original originator protected because they no longer hold the risk after selling it. Now, do not underestimate how powerful that last step is. It is not about whether someone technically committed fraud, it is about how the incentives work. If you can originate and sell, your best business is to keep origination growing. Your best business is to create demand for the product. So if you are a bank, you prefer rising collateral prices. If collateral rises, the product looks safer. If collateral falls, the originator is already gone or protected. That is why in the old cycle, banks were incentivized to expand mortgage lending to people who did not have stable income, not because they were generous, because the loans created fee revenue and the bundling created downstream demand. And then, when the default wave hit, the losses were not where the profits were. Now in 2026, the incentive map is repeating with new inputs. Instead of mortgage originations, we have capital expenditure financing and leaseback structures. Instead of homeowners buying houses, we have pension funds and insurance companies buying rated products. Instead of a stampede into housing, we have a stampede into yield, especially yield that looks like investment grade without doing the hard work of assessing the true underlying default risk. But here is the second cliffhanger, and it is the one most people miss. Even if the rating looks safe, the product can still fail through liquidity, duration mismatch, or refinancing constraints. It can fail not because the world collapses overnight, but because markets stop being willing to reprice risk at the old assumptions. That is how you can get a crash even when the average person has not heard the word SPV or structured credit in their life. Now let us talk about the part nobody wants to say out loud. In many cases, the losers are not the AI companies. They can renegotiate, they can walk away from leases with penalties, they can fund through equity markets if the market is open. The losers are the people whose retirement money was allowed to buy the bond structure. The losers are pension plans and insurance companies that believe the rating language. The losers are ordinary investors through mutual funds or ETFs that hold the paper. And if you want the emotional core of this, it is simple. You are being used as the balance sheet. Your savings are turned into a funding source for deals that quietly distribute risk away from whoever created the cash flow promises. Now we have to bring in another reality check from 2026. Global debt is enormous, above $300 trillion worldwide. That is not a slogan. It is a macro constraint. When debt grows that large, refinancing risk becomes a default risk. When rates are not zero, the cost to roll over debt is brutal. So even if a bond looks safe at issuance, the bond market can turn toxic when everyone needs liquidity at the same time. You do not even need massive fundamental defaults. You only need a market-wide inability to price uncertainty, and uncertainty is the oxygen of financial panic. In the old crisis, the panic arrived when homeowners stopped paying and house prices stopped supporting recovery values. In the new cycle, the panic can arrive when asset values tied to technology infrastructure stop matching the assumptions built into structured products. The data center cash flows depend on AI demand and continued willingness to pay for older capacity. The technology economy can change faster than contracts. If the market discovers that the collateral is aging and losing value, it starts to question how safe the structure really is. Now let us connect this to something else people struggle with in 2026, the retirement illusion. Many workers think the system is a promise. They think if they work and contribute, their future income is guaranteed. They do not understand that retirement is now a market bet. Most pension funds and insurance portfolios adjust allocations based on capital market conditions. If the assets they hold suffer drawdowns or liquidity haircuts, the plan can change benefits, increase contributions, or delay payouts. Meanwhile, Social Security pressures increase as populations age. In many countries, including the United States, the retirement age delays have been the political answer to an underfunded system. Nobody wants to say it directly, but it means the average worker will work longer for less certainty. So if those retirement and insurance pools are buying structured credit disguised as safety, then a shock to that credit can ripple into the real world. It can tighten budgets, reduce benefit availability, and push more people into working age vulnerability. Now here is a third pattern interrupt. Look at what is happening in creator culture and AI disruption, because the system needs scapegoats. In 2026, people are being told to learn to code again, or to pivot into micro businesses, or to build passive income channels. The creator economy is selling dreams, but most creators make near $0. Most subscriptions and ad revenue do not cover real costs. The illusion works because it frames economic insecurity as individual failure rather than systemic risk. If you are laid off by AI automation, you are blamed for not adapting fast enough. If you cannot afford housing, you are told to make better decisions. If your inflation-adjusted salary shrinks, you are told you should manage your budget better. Meanwhile, behind the curtain, structured products keep moving capital toward the people who understand the incentives. That is why the stock market can rise while your life gets smaller. The stock market reflects a concentration of wealth and ownership. The real economy reflects wage stagnation, housing costs, insurance costs, and layoffs. Now, you might ask, why are the risks so hard to see? Why are the packaging mechanisms so invisible? Because the system is built to hide risk behind compliance and documentation. Because the products are sold with ratings and simplified narratives. Because your retirement manager has quarterly targets and may not have the patience to dig through every tranche or every assumption. Because ratings agencies have incentives, and because once a product is branded as safe, institutions can avoid uncomfortable scrutiny by trusting the stamp. Trust is the lubricant of this machine, and it is engineered. Now we should talk about what happens when the safe stamp meets a technology reality shift. Let us go back to the AI infrastructure premise. AI needs compute. Compute uses chips. Chips have a life cycle. If a new generation of chips doubles performance per dollar, the economic advantage of older hardware collapses. Data center hardware is not a permanent asset in the way land can be. It depreciates by progress. So even if the lease contract remains legally enforceable, the economic value of continuing to operate that specific capacity can disappear. A company can decide to migrate workloads. A landlord can decide to discount payments. A refinancing can fail. And this is where liquidity becomes the silent killer. Structured products can rely on refinancing markets staying open. If investors demand more yield, spreads widen, and the cash flow waterfalls do not cover obligations, paper assets can turn illiquid quickly. In that moment, the rating is irrelevant. What matters is whether investors are willing to buy or whether they freeze. This is the part where history becomes useful. In 2008, the initial defaults were a spark. The real fire was the revaluation of risk and the collapse in market liquidity for structured credit. In 2026, the equivalent spark can come from any place where assumptions about future capacity demand break. Now I want to circle back to the opening idea that big short behavior is coming back. People like Burry did not just bet against an asset. They bet against the narratives that kept markets calm. If similar actors are now looking at AI infrastructure financing and seeing the risk stacking underneath, it means they are noticing the mismatch between promises and underlying economics. They are noticing that the profit is not tied to sustainable value creation at the consumer level, but to financial engineering and capital market access. That leads to another painful truth. Many AI profits, especially in the early stages, are not profits in a cash sense. They are accounting profits, revenue estimates, and valuation